It's been a wild year in the markets, with 2020 characterized by wild swings in equities, a flight to the tech titans, and interest rates plummeting to historic lows. That volatility underscores the importance of prudent management to build a durable, well-diversified portfolio to guard against unexpected bumps in the road. Over the course of the next half hour, we'll take a look at how Mackenzie Investments helps clients navigate this uncertain environment through prudent advice and deep market knowledge. Joining me now for more insight is John Cook, Portfolio Manager of the Mackenzie Global Environmental Equity Fund and President and Director of Greenchip Financial Corp. Welcome, John.
Hi, how are you?
Great to have you. John, we've heard a lot about tech this year. Does the environment remind you of the dot-com bubble?
It absolutely does. And you mentioned the FANGs. They're the clear winners out of this. It was less certain who the winners were going to be in the dot-com bubble. But we have many other companies that are trading at ridiculous multiples of sales and huge market cap valuations that to us are going to have a really tough time on the other side when this bubble finally deflates. The real challenge for us in these bubble economies is they clearly are a misallocation of capital. And it's so clear right now that we need to rebuild infrastructure in this world. We need to create a more sustainable economy for the future, and that's going to take capital investment. And when we're investing too much in companies that either look really certain but don't have any use for their capital, like the FANGs, that are producing lots of free cash, but using it to buy back their stock or dividending it out, not really growing their business, that means there's less capital that can go to building this more sustainable economy. Now, I don't want to say that our sectors, the environmental sectors, are not exposed to the bubble. We have some Hollywood stocks in the mobility sector, like Tesla and Nikola, and some of the plant-based protein stocks. So it's not like we've been totally unexposed to this, but I can tell you, if you look closely at our space, for managers that follow it, there's still some very well-priced businesses that have tremendous growth in front of them that I believe the market is missing because they're not as focused on this space. And so, yes, we're in a bubble economy and it really worries me, but I do think in our specific sectors, there's opportunities that for companies that are going to survive on the other side.
What makes this different than the last dot-com bust?
I think the differences are kind of macroeconomic and societal. For example, there's certainly less faith in institutions than there was in 1999 or 2000. It has absolutely exploded since then. So our central banks have so much less dry gunpowder to deal with the inevitable deflating of the bubble, and this is really concerning.
John, is value investing dead?
No, well, perhaps the idea of just buying low PE and low price to book stocks and sitting on them and hoping that the market recognizes some sort of growth for these companies that may or may not exist. Maybe that's dead. But to me, to our firm, the idea of valuing or discounting future cash flows still really matters. And the best long-term way to improve the performance of portfolios is to find those great future streams of profits at a reasonable price today. It helps you through volatile times, and it helps you be more thoughtful about the businesses that you're actually investing in.
Where are you seeing opportunities right now to invest?
Oh, there's so many in our spaces, as you can imagine. Last year, I talked a lot about solar, and I think the market's catching up with some of the opportunity that we've seen since 2012, really, in the solar stocks for us. But others that I would point to right now, the circular economy, the idea of recycling and reusing materials, doing more with less. There's a number of companies we've invested in that I think the market is mispriced in that area. Another area that we're really interested in is this idea, as we move from liquid fuels to electricity, is most of that electricity has to run through some sort of power management. So power management, semiconductors, and passive electronics that make our refrigerators, our lighting, our HVAC systems, our industrial factories more efficient. There's tremendous opportunity in some of these businesses that are finding new sales channels that traditionally were more focused just on consumer technology.
John, what is your investment philosophy and strategy?
We classify ourselves as value managers in a growth space. So we absolutely pay attention to the value, the price that we pay for a company. We rely heavily on discounted cash flow modeling to come up with a target price and try to buy businesses that are trading at a discount to what we think they're worth. I think that there is huge growth in our space. So we don't just rely on the metrics that you would see, the nameplate metrics. But if you averaged it out across our entire portfolio, by most metrics, we would look less expensive than the broader market.
That's great. Well, let's just pause there for a moment, John. We'll be back after this short break. Welcome back. I'm joined with John Cook, Portfolio Manager of the Mackenzie Global Environmental Equity Fund and President and Director of Green Chip Financial Corp. John, we're all experiencing the fallout from this global pandemic. In your mind, has the crisis revealed or reinforced anything for you?
Oh, yeah, it's a mix. So it's a mix. We have some sectors that have actually done very well through COVID, and you have to be careful talking about anybody or anything doing well through COVID. But it's identified things that we need what we need. And so, we have invested in sustainable agriculture, and people need access to good, healthy food. We invest in water technologies, and obviously our people and industries need access to good, clean water. We need access to reasonably priced electrons. And we need access to home technologies and whatnot, which is not so much in our space. But the idea of being at home and using video conferencing and so on is changing other parts of our sectors. And this is the one that's less certain to us, which is mobility. And so, we have seen people leave their cars in the garage, they're flying less, and they're certainly not on cruise ships. And the part that we care about the most is trying to get people into more efficient means of transportation, which would be buses and trains. And right now, operators of mass transit are having a really tough time, lower ridership. And the big question out of COVID, is that going to come back? So it's a mix.
John, always very interesting perspectives. Thanks so much for being with us.
You're welcome.
Stay with us too. We'll be right back after this short break. Welcome back. We're talking about what a well-diversified equity portfolio looks like with technology stocks in the spotlight. I am joined by Richard Bodsey, Portfolio Manager, and Greg McCullough, Assistant Portfolio Manager with Putnam Investments, Inc. Putnam Investments, Inc. is a sub-advisor to the Mackenzie U.S. All-Cap Growth Fund. Richard and Greg represent the portfolio management team on the fund. Gentlemen, welcome, and thanks for joining me.
Thanks for having us. Great to be here.
Richard, your investment process incorporates investment themes. How does your process give you an edge to ensure that you're identifying, investing in true themes and businesses rather than just fads?
It's a great question. The themes we invest behind are multi-year in nature. So it's not necessarily going to be a quarter or a year that these trends occur, but instead, sometimes it's 5 years, sometimes it's a decade. We're happy to get into the different themes, but they're long-tailed and they extend across an investment cycle.
What are your highest conviction ideas in the growth universe today?
A couple ideas that we'd highlight. The first one is IDEX, which is a company that does veterinary diagnostics, predominantly in the US, but has an opportunity to expand overseas. It's a company with 70% market share at point-of-care veterinary facilities. Another company I'd highlight, another idea that we really like is Dexcom, which makes continuous glucose monitors for diabetics, for type 1 diabetic patients and increasingly for type 2 diabetic patients. And we've seen the digitalization across different industries and moving away from finger pricks to being able to track glucose levels and all kinds of different blood levels is very important to what is a large patient population.
Interesting. Now, outside of technology, what sector are you most excited about?
I'd say generally we're attracted to businesses and markets with high levels of innovation and where technology and investments in R&D can drive growth. So if you look outside of technology, this often leads us to businesses in the healthcare sector, some in consumer discretionary, and some within industrials. Richard just gave an example of Dexcom, which is a CGM manufacturer. This is a business with high levels of R&D, high levels of innovation, technological differentiation, and they're servicing a market that is very large today and unfortunately in some ways is growing at a pretty high rate. So, this is a company that is outside of the technology space, but technology is front and center in their product offering, and they're serving a huge market that's only going to get bigger.
Let's take a short break. Stay with us. Welcome back to the show. Richard, every growth manager is looking for a high level of growth. What is it that you do differently in your fund?
In addition to seeking a high level of growth, we also seek duration of growth. So we're investing behind companies that can grow at above market rates and do so across a cycle and do so in a variety of economic condition. These are companies that are aided by these themes, which are top-down in nature and multi-decade trends. So whether it's increased screen time where we own Adobe, or contactless payments where we own PayPal, or e-signature enablers where we own DocuSign, these are markets that are growing. These are themes that enable above market growth, and we're invested behind the companies that we think are the largest beneficiaries of these themes.
I would just add that another thing that we look for names in the portfolio are businesses with a narrow range of financial and operational outcomes. So we're really attracted to businesses with high levels of recurring revenue, long-term contracts, the ability to price their product, particularly if there's a raw material input with some volatility into their cost of goods sold. But these are some of the attributes that we look for in businesses across the portfolio, and we really do try to focus the holdings in the portfolio on high quality businesses that have a narrow range of outcomes.
Greg, looking into the future, what are some multi-decade trends you see in a post-COVID-19 world?
That's a good question. We clearly see, first of all, that a number of the trends that we had represented in the portfolio coming into this have been accelerated. And I think that's been pretty clear, whether that's increased screen time, software as a service, cloud infrastructure. Those are trends that were well in place and have only been accelerated. And we think we'll continue to see growth from companies as a result of those trends. But as we look into some other areas of the market, we see pretty substantial changes in consumer purchasing preferences, and we expect that to drive really change behavior on a structural basis going forward. A lot of it has to do with e-commerce and the digitization of the consumer purchasing process. So that could come through for a business like Walmart, who's going to see increased incidence of order online, pick up in the store, particularly for grocery. That could come through for a business like Chipotle Mexican Group, which has increasing digital penetration and a very strong and loyal user base. So we see it in a number of areas. Certainly some of that will be given back, but a lot of it we think will be structural and carry forward on an ongoing basis.
Richard, would you like to add to that?
I think Greg touched on a lot of key areas, and I think an overarching theme of what we're seeing is a digitalization of areas of the economy that were not previously susceptible to digitalization, and also, to Greg's point, an acceleration in trends that were really long-tailed in nature that have been accelerated because of what's happened with the pandemic. So I mentioned before PayPal, which we own, and they were growing their user base nicely at 15% per year with each year. And then all of a sudden this year they had 70 million people sign up for their service across PayPal, Venmo, and other areas of their business. So that's just one example, but there are others within the portfolio where these decade-long trends really saw an acceleration in 2020. There's about 20% of the universe that we look at that actually has higher consensus estimates for 2020 and 2021 than they did at the beginning of the year. And the fund and the portfolio are over-indexed to those companies because there are structural winners coming out the other side of all the different changes that occurred in 2020.
Well, gentlemen, thank you so much for sharing your insights with us.
Thank you
very much.
Let's stay on equities and talk to Darren McKiernan, Senior Vice President, Investment Management and Head of the McKinsey Global Equity and Income Team. Welcome, Darren.
Hi, Kelly. Nice to see you again.
Nice to see you too. Listen, global market returns have become increasingly concentrated within fewer and fewer companies in the last few years. How do you navigate this concentration when constructing portfolios for your clients?
Yeah, well, Kelly, obviously you're referring specifically, I guess, to the FANG stocks and more generally to technology. And just by way of example, technology and FANG stocks make up about 30% of my global benchmark today. And actually, that's somewhat understated because what it doesn't include are those Chinese technology platform companies like Alibaba and Tencent, JD.com, which would add several hundred more $1 billion worth of market cap into that benchmark if they were included. But if you think about concentration and how it's sort of evolved over the last little while, break the market up into quintiles in terms of size. If you took that largest, sort of the number of companies that are part of that largest, call it quintile, the number of names that are included in that quintile has gone from like 44 to 20 over the last 10 years. So way more concentrated, as you pointed out. And of course, everyone knows, a lot of return have come from those very sort of specific names, specifically the FANG. And of course, technology has been what's been driving the market the last few years for sure. So because it's going on for what seems like forever, people can ask, like, why do we even bother looking at anything else, right? And we've internally debated ad nauseum what to do in a world where you have this extensive, narrow leadership in the market. Well, to us, the answer is actually pretty straightforward, and it's called diversification. We run core global funds, and as a result, we're meant to have sort of a good balance across our mandates. Now, of course, FANGs have driven the market and technology in general, and they're excellent businesses in their own right, but they're not the only ones out there that we think deserve attention. And there are many companies besides the FANG and the tech sector in general that provide an excellent source of returns and diversification. Now, don't get me wrong. I mean, we own some of these, okay? 20% of the fund or so is in technology. But it's our opportunity and it's our job, frankly, to find those companies that are not FANGs, and which is basically makes up 80% of the rest of our portfolio. Diversification is also important because we think, when the virus concerns ease, the world starts opening up again, the global economy starts recovering, we think there's going to be a bit of a regime change in the market. And so a lot of these industries and companies that have sort of been lagging, I think, are going to probably improve, certainly from a relative standpoint, performance standpoint, relative to sort of what's been leading the market over the last couple of years. Now, of course, I don't know when this is going to happen in the next couple of quarters, 12 months, 18 months, who's to say? But, we're always thinking about how to diversify the portfolio so that we own these businesses. So when the market sort of shifts and you're not sort of stuck on that one side of the boat, proverbially speaking, and we're going to be prepared for that. Now, this doesn't mean we're selling out of all of our Microsoft or Apple tomorrow. I mean, these are companies that we've owned for over a decade. But we think there are rich sources of diversification in other parts of the market. Now, specifically, let's talk about financials. Now, banks in particular have been a really tough place to be over the last couple of years. Certainly, as interest rates have come down, their net interest margins have spreads have narrowed, and of course now they're dealing with loan losses and provisioning as a result of the pandemic. But there are parts of the financials that have actually done pretty well, and which we I think are going to do extremely well when we come out of this. Financial exchanges. We actually own 5 of these companies across various parts of the market. I can speak specifically the CME Group, the Chicago Mercantile Exchange. This is a company that's been around for over 100 years. It is by far the most diverse operator of derivatives exchanges in the world. And a big part of their business is helping companies hedge off volatility and interest rate risk. And of course, with interest rates being so low, like people haven't really needed to use their those kind of contracts and products. But we think, again, when the global macro economy starts to pick up, and there's sort of even a sniff that interest rates start to move up, this is a business that's a part of their business that's going to do very well, and we think it's massively under earning today as a result of that. So in the meantime, we wait. And the great thing about this company and about almost all exchanges is, they don't require a lot of capital. So as the year over year, they're, I know the CME in particular, I think dividends out almost 60% of their after-tax earnings. So we're kind of sitting here waiting for, it's a nice little call option in a world that might change someday. In the meantime, we're getting a pretty good dividend payment while we wait for that to happen. We also have risk diversification limits on position sizes. We believe that no matter how much you know about a company, how well you think you know management, how well you view the industry, things can go wrong. And so you're not going to see these, 10, 15% positions in the fund, just because based on our mandate, we just don't think that's a prudent way to manage money, certainly given the expectations of our unit holders. So at the end of the day, as global core managers, our job is to provide our clients with attractive risk-adjusted returns. And to do this, it's important we put together a portfolio that is diversified by end market, by valuations, and of course, by industries.
That's great. Thanks for breaking that down, Darren. Now, you focus on industry-leading companies that deliver higher returns on invested capital than their peers. Can you give us some examples of these companies and why this characteristic is so important to you?
Yeah, you're right, Kelly. We've always focused on businesses that we think are as high up in the value chain and in their industry, and as a result, generally have superior return on invested capital. Some examples: we own a Swedish company that makes vacuum solutions and air compressor solutions for production facilities. It's called Atlas Copco. Now, this is a company that generates return on invested capital of around 25% through the cycle, which, compared to most even high quality industrials, generally, those sort of even a high quality industrial will generally generate about a 15% return on capital. So much, much higher. We own Texas Instruments. It's one of the world's leading analog semiconductor company. They've got return on invested capital in the 35 to 40% range, which is amongst the best, not only in just semiconductors, but of all of technology. We own a Swiss company called Zika, which makes building and material additives and chemicals. Now, Zika literally has returns that are 3 times that of a typical commodity chemical company. Closer to home, McDonald's, Starbucks, again, amongst the highest return on invested capital for businesses that partake in the consumer discretionary space. Now, why do we like to own these types of businesses? And again, I can leave it at one word: it's optionality. And I'd also make a comment that great ROIC companies gives you some sort of margin of error. So if they have a bad quarter, or perhaps they need a better management team, because the entrenched nature of the business, the high quality nature of the business, these companies can still survive. I often joke with my team. I say, look, I could probably take over Moody's or Diageo or Colgate for a few years and before it would go off the rails. This is the nature of these types of companies. And finally, I'll make a comment that you don't need massive growth for these businesses to do well and get actually a pretty good rate of return. I said because of that optionality, because they have all these sorts of levers to pull in terms of creating value, it's not dependent on having a 15 or 20% top line growth to get a really good absolute return. And by and large, these businesses actually have lower volatility than the average company because of their quality. And so, again, as a core manager, we don't need to focus on any one particular sector to find these businesses. We can find them anywhere in the world across multiple industries.
Darren, are there themes that have emerged or accelerated during the pandemic that you believe will live well into the future?
Yeah, Kelly, I don't profess to have any great insights here. I would comment on what I've observed and what we've seen from the data. The first point I'd make is, just interviews like this. The fact that, the only way I can communicate with my team is through Zoom or Teams or technology that we're using today. The interviews with the prospective companies that we're looking to invest in. Again, this is all done remotely. Now, I don't think that's going away permanently at all. In fact, I think that for a large percentage of the white collar and office workforce, working from home is going to be a permanent part of their jobs, and that's good. That's got good things and bad things. I would also say that, and I think as Richard and Greg mentioned, talking about e-commerce, I would second that and follow it up and say, what's happened over the last 6 months from a penetration standpoint in the U.S. I read some stat where e-commerce as a percentage of retail sales has made up as much ground in the last 6 months as it has had the previous 10 years, which is pretty incredible. And anecdotally, that's the data, but anecdotally, I can comment on my mom's behavior, right? The woman in her 70s who 6 months ago, asking her to buy groceries online, she would have looked at me like my nose was missing. But now, today, not only does she buy groceries, she does her online banking, Uber Eats. She prefers that as a mode of sort of doing business now, which is something I wouldn't have thought happened, 6 months ago. But whether it's the work from home and the infrastructure that's needed to build the work from home environments in a safe and secure manner, whether it's the ability to facilitate the growth in e-commerce that Richard and Greg mentioned, the underlying sort of ingredient or commonality here is the investment in silicon or semiconductors. And that is a bedrock for all this stuff. Now we've had a big investment in semiconductors for a while. In fact, it's one of our biggest subgroups in terms of our investments. And we've invested across the value chain, foundries, analog to digital signal processing companies like Texas Instruments, image sensors, radio frequency chips, capacitors. The trends that have happened over the last 6 months, we think have just reinforced our view in terms of the long-term attractiveness and growth of these parts of the market. And so if anything, all those sort of trends that we think are being reinforced, like I mentioned, work from home, I mentioned e-commerce, that's all being supported by our investments, or our investments in semiconductors are all supporting those trends.
Darren, thanks so much for sharing your expertise with us. It's always such a pleasure to chat with you.
Thanks, Kelly. Appreciate the time, and I hope everyone has a great day.
I want to thank all of our guests for their thoughts and insights today. Join us next time on the Special Talk series, Building Portfolios for the Next Decade, here on BNN Bloomberg.